We want to welcome everybody to this session. We know it's a sacrifice for us to be, meeting, taking time out as an investment community to be here discussing the way forward. I hope to have a very engaging conversation with all the members today. I'm going to be guiding us through what we believe is a relevant topic during times of volatility in terms of how governance, the importance of governance during this. My entire conversation will also speak to the way forward. And, as a member of a financial institution, our job is also to see how we can help. Rather than highlighting just what the problem is, we're also here to provide solution. All right. So in terms of the broad overview, we're going to talk about who we are as in JMB. Just briefly also to say who I am. In terms of, we're going to talk about what governance is, and then we're going to have a conversation around the macro picture. 2020, as a matter of fact, over the last 10 years, it is safe to say that there are investment professionals now who have never seen an investment climate like what we've seen over the last 10 years.
Sorry to interrupt you.
We're going to talk about the threats to the business model, the whole business model of financial intermediation.
Peter.
Then we're going to talk about what's the fix to those models, and how governance can actually help guide us through these turbulent times. And then we'll close off with a discussion around how we see ourselves as JMB playing a role.
Peter.
All right.
Peter Thompson. Peter, you hearing me?
Loud and clear.
Okay, Peter. So let me apologies for the technical issues. Let me just officially welcome everyone online. Before I ask you to start the presentation, Peter, I actually had an introduction just to get everybody in the room to get to know you better. So I'm just going to introduce you officially and welcome everybody to this session. As you mentioned earlier, the session is on a sound governance structure with a nimble profit-making business model, that creates a beneficial and symbiotic relationship. So before I hand over to Peter Thompson, I'm just going to give an introduction to tell everyone in the room who is Peter Thompson. And he is the group manager for client investment at the JMB Group. As you know, we're headquartered in Jamaica, but we have offices in Trinidad and in Dominican Republic. Peter is responsible for coordination and implementation of the discretionary group investment management framework across all JMB subsidiaries as it relates to client investment portfolio, construction, and management. So Peter oversees a team of investment professionals that are responsible for the management of pension funds, mutual funds, and customized portfolios. He joined the JMB team in 2002 as a research analyst and has since held the positions of business development analyst, business development manager, and manager of group product portfolio. Peter holds both a master's and a Bachelor of Science degree in economics from the University of the West Indies, Mona, and is also a CFA charter holder. Peter is a trustee of the Urban Development Corporation Pension Fund, a director on the board of the National Insurance Fund Resort Management Committee Limited, and Cygnus Credit Investment. He's also a founding member of the CFA Society of Jamaica. Since 2014, he has been an adjunct lecturer at the Mona Business School, UWI Mona, delivering courses in finance and investment management. So Peter is that is who Peter is. I had the pleasure of introducing him. So I'm now going to hand over to Peter to go ahead with his presentation. I'd like for persons online to just post the questions that you'd want for me to to ask Peter at the end of the presentation, and we will just kind of flow thereafter from there. So Peter, over to you, and thanks again.
All right, then. Thanks, Alwyn. I think since this is being recorded, I'm also the husband and a father, right? Can't leave that part out, just for the record. All right. So again, welcome everybody. And in terms of the flow, we can take questions at the end, but we expect to be answering as many questions as possible. All right. So this is the overview in terms of how we're going to be doing it. So about the JMB group. So JMB group, we have origins in Jamaica. 1992, a lady with an idea decided to say she wants to change how the entire financial system, how to give access to small investors in Jamaica. And it's safe to say she will be very, very proud that she did an excellent job, because years after her death, we continue to carry on that mission. JMB has grown significantly since then, and with offerings in capital markets, investment management, portfolio management, advisory services, doing some of the biggest deals in the Caribbean to date. We also have pension fund management, and we manage institutional money. So a part of my role as investment manager is to actually manage clients' portfolio, and these clients include not only retail clients but institutional clients. We have operations in Jamaica, Trinidad, and the DR, and we are the largest shareholder in Sagicor Financial Corporation, an entity that has tentacles in insurance right across the region and in the US. Listed on both the Jamaica Stock Exchange and the Trinidad Stock Exchange, and closing out 2021, we made around 9.2 billion in operating income. All right, so just jump right into it. So governance is defined or refers to a system of internal policies and procedures that are used to manage an organization, right? The whole framework is designed to outline the key roles and responsibilities of different stakeholders in the organization. The entire essence of governance is to ensure that we have the right persons doing the right things, and there are checks and balances within the structure. For this discussion, we're going to look at governance from the narrow lens of just the assets, managing the assets of the financial institution. Because governance goes even well beyond that, and it's getting even more complex in terms of when we actually look at everyone becoming more socially responsible. So governance has reach even within that sphere. But we're going to narrow down the discussion now to the management of the assets of a financial institution. All right, so to do that, we can't do it in isolation. We have to look at what the big picture is. What is the environment in which we're operating in? Because it's significant. It's during times of distress that issues of governance are even more critical. So the blue line represents the yield curve as at 2019. The red line represents the yield curve 1 year after. What we saw was a 156 basis points. I'm going to call that a shift in the yield curve between 2019 and 2020. A big part of that is, everybody knows, quantitative easing, cheap money on the system, keeping the economy going. We've seen that trend from 2008, where expansionary monetary policy right across the globe has basically meant some of the lowest interest rates we've seen in a generation. Since 2020, we've actually seen yields actually pivot upwards, increasing by around 55 basis points. Now, this is within the context. This is more like a pivot in the yield curve, or a tilt in the yield curve. Since then, the flatness or the slope of the yield curve has changed between 2020 and 2021, which is relevant for persons involved in financial intermediation. We also looked at the pandemic performance, stock markets right across the globe. So we chose both developed markets and markets within our region. So at the heart of the discussion, or the height of the pandemic, we saw, once the COVID-19 was declared a pandemic, we saw all stock markets right across both our region and across the globe decline significantly. We also saw again another dip in stock markets within the talk of new variants. Since then, we've seen, the rollout of vaccines. We've seen markets in which there are ample supply of vaccines actually maintain their upward trajectory. Markets that, the rollout of vaccine is less than ideal, whether it be a supply issue. But we have seen markets, there's a strong correlation between how much vaccines have you put in the arms of people and how your performance of your stock markets. It's not surprising, right? Because stock markets look forward, not at the now, they look forward. And with more vaccines in the arms of people, the outlook looks much better. In our smaller region, Jamaica, and to some extent in Trinidad, we see that those markets are relatively flat. We have recovered some ground since the pandemic, but not a whole lot. And it's not surprising. We're small island states with a focus, with a big part of our economy based on leisure or raw material. All right, unemployment again in the developed markets, UK, US, and Canada. Again, right around the time when there's a pandemic, unemployment spiked. Now, UK stood out somewhat because UK's response to the pandemic is that they had a very, very generous program where basically put people on furlough rather than having them stay home. So technically, they were getting a check, and as such, they didn't count as unemployed. And as such, that is factored in why we're seeing their numbers so low throughout the period. But for other markets, we saw unemployment right across the world actually spike. In terms of GDP growth, so we got the data from IMF data on developed market GDP growth and Latin America and the Caribbean markets in terms of their overall growth. Our first scenario is 2008-2009, which at the time was seen as the largest decline, the biggest global recession we've seen in a generation, where we saw world GDP actually decline by around 1%. European GDP fell by around 4%, and Latin America around 2%. Fast forward to a health crisis, and which translated into a pandemic. We're seeing where GDP fell right across the world. It's estimated around 3.3%. Now, at the height of the pandemic, the estimates were worse than the projected GDP for the world was worse than 3%. But in latest data is showing around a 3.3% decline. EU declined around by 6%, and Latin America and the Caribbean around 7%. Now, so this is what we went through in 2020 is the worst financial decline we've seen since the Great Depression. Where at 2008 we thought it was bad. However, when it comes on to health and then the drastic measures taken to curtail the spread, it's no surprise that GDP contracted so much. So what? Why do we even care? Why do we care about what happens in US and those other markets? Why do we look at US treasuries, right, rather than look at our regional rates? The essence of it is that US treasuries is a risk-free rate, so globally. So these rates set rates right across the globe. So if US rates move up, it is pretty sure that assets will be repriced based on that because US rates are the risk-free ones. We also are tied at the hips with our more developed markets within this region. US, Canada, and the UK represent some of our biggest demand trading partners. Plus, in terms of goods and services, this is where most of our goods and services go. In terms of tourism travel, we get these markets represent the biggest share of our tourism arrivals. The diaspora also, everybody knows someone in New York. The Caribbean nationals are all across these regions, and they provide a significant source of remittance to these countries, back to the Caribbean. So what happens in these countries, US, Canada, and UK, is very, very relevant, right? So a growing world economy also support commodity markets, which, you know, we are suppliers of these raw materials. Jamaica has bauxite, and Trinidad has oil. All right, so just to refresh everybody's discussion around what we do as financial intermediaries. We stand between persons who have excess capital and persons who want excess capital. So the entire role of a financial intermediary, whether it be a credit union, a bank, a building society, we stand in between persons with excess capital and persons who want excess capital. So since the dawn of times, or since the invention of banking, we've seen where it's a beneficial arrangement between, where someone is in between those who have and those who want. Now, the job of the financial intermediary is to create solutions that are able to meet both parties. So on the agents who have excess capital, we give them savings accounts, checking accounts, or whatever, deposit or investments to actually access their capital. And those who want, hence, loans to buy a house or expand business. That's our role. We are in between, and we are designing these credit facilities. In exchange for that, we collect the differential between the rate that we charge on our loans and the rate that we pay out on our deposits. And the legal term of it, you may not be able to call it a deposit, but the essence of it is I'm borrowing from one group and lending to another group. I'm borrowing short and lending long. Now, the essence of that, for that, we get a spread. That spread is to compensate for all of the risk involved. We're taking credit risk, we're taking liquidity risk, maturity risk. And our role is critical as we know it. So think about a system without financial institutions, and 2008 reminded us of how what started out as a banking issue meant that people could not get paid on a particular day, and it's not in the same industry. It has nothing to do with finance. Farmers couldn't make payroll because the credit markets dried up. So financial intermediation is a critical role. And the risk taken on by financial institutions to get that done is something that is real and significant. All right, so the challenges now that the financial models face in 2008, we saw where trust, to some extent, was completely eroded. The entire system is based on the ability for people to put down deposits or make short-term investments, knowing full well that anytime they want it, they can actually get it. Now, if everybody try and get their money at the same time, it is an issue. It means it's stress on the entire system. So trust is at the heart of it. In 2008, it was tested with the failure of a couple institutions. And again, it's not surprising, bringing Bitcoin and cryptocurrency in the mix. Bitcoin wasn't created in 2020 or 2021. At the height of the pandemic, that's when the first code for Bitcoin was written. And it is not surprising that it has flourished. It flourished during that time because people lost some amount of confidence in the system, and as such put their hopes and trust in an alternative. Now, regardless of what may happen to the respective cryptocurrencies themselves, what we know is that the technology behind cryptocurrency has the potential to disrupt the entire financial intermediation model. So as I imagine a structure in which Facebook, which has all of your data, and YouTube that knows more about you than your significant other, is able to use that data to be better adjudicators of credit. So imagine a structure where people are able to borrow and lend without the need for someone in the middle. And cryptocurrencies eliminate the need for any form of trust, or the blockchain technology behind cryptocurrencies allows for that issue. Now, the financial institutions, as what that means is that financial institutions as we know it need to change, because it's not going away. This technology, once the Pandora's box is open, to close it is or to ignore it would be short-sighted. So remember, we take spread risk, borrow short and lend long. So the short-term rates and long-term rates is an indication of how profitable we are. The flatter the yield curve, the worst case scenario for us, because if short-term rates and long-term rates are the same, then there's not much spread that we can generate. Now, in 2019, the yield curve was relatively flat, which is a sign of something to come. Financial institutions' profit were somewhat affected. Quantitative easing tried to fix that issue by pushing down short-term rates as much as possible. And in 2020, we saw that taking place. Since 2020, we've seen the slope of the yield curve slope more as inflation concerns creep back into the global space. What we know, the takeaway from this is that it's not a set it and forget it. It requires constant monitoring. The management of credit risk and interest rate risk is significant for us as financial intermediaries. Now, our core business may be to lend, make loans, but where there's competition within the space, which is forcing us to be as nimble as possible in terms of to ensure that we can manage the spread risk as much as possible. All right, so the so what again? Right, so the regionally highly correlated entities are within the region where our fate is tied to what happens up north. They're based on our large diaspora and our strong trading relation. No, so it's relevant, right? It's critical that we pay attention to what happens in these markets. No, to say we're going to try and decouple ourselves, that's not it would be hard. What we do know is that, and it's something that should be discussed at this conference, as a group, as small island states, how do we compete within our different entities, but actually benefit as a group in negotiations and as we tackle these complex issues facing us. So the big issue is that we're seeing international markets are volatile. Interest rates is more volatile. It's very volatile. Global recession took place. We're recovering. Travel and leisure took a hit. When and how it comes back will be a function of vaccines. But the takeaway is that global volatility is here to stay. It is critical, therefore, that we pay attention and actually develop strategies to help us during this time. All right, so the model, the financial model, at risk because of lower spread and volatility risk. The competition is going to come from non-traditional sources. Now, our overall our operational costs will increase in terms of getting enough resources, getting as we compete. Our operational costs may be a significant part of our spread, because if our top line is not increasing and we're maintaining the same efficiencies within our organizations, then we're going to see our overall operational costs as a function of our revenue falling in general. Regulatory and security costs is a thing. We don't have to, as we get more digital, the security costs associating with just managing people's money and securing it from hacking, online tampering is a huge thing. And regulations, out of every crisis, what you can expect is increased regulatory scrutiny. Within our region, we have significant concentration risk. Our depositors and our borrowers are all within the same space. Within our the exposures that we face, leisure, commodities. So once there's a fall off in travel, or once there's a travel in commodity prices, we expect our borrowers to feel the pinch and affect both our deposits and our loans. The concentration also, the rules are set up now. Credit Union A in Trinidad or Dominica, being able to have borrowers or lenders in outside of the jurisdiction is almost unheard of. And as such, there's your business model is concentrated at country level. So in essence, your entire portfolio, assets and liability are correlated significantly to have significant amount of current country risk. In a perfect world, we should be able to diversify right across the region. Again, when you add the total composition, population of the English-speaking Caribbean, it's smaller than the overall size of New York. So operating as we're trying to build our model without factoring in efficiencies in it is something that we have to look at because it represents a significant amount of risk. So what's the fix, right? Spread, the top line is contracting. How do we continue to make money? The drivers, volumes, you can try and always increase loans, or you can do it via spreads. Try and manage your cost of capital much better, and increase the overall asset returns. Fees, you can try and increase value-added fees. However, there's a pushback right across the globe against nuisance fees. You're putting your money in, you're getting 0% return on it because the cost interest rates are so low, but at the same time you're being charged fees. So how do we reduce those nuisance fees and at the same time be providing value-added services to be able to charge and earn non-interest or non-core revenues is something to look at. The cost structure, how do we reduce the overall operating cost structure without impacting service quality or taking on more operational or asset risk? So if we try to increase the volumes of loan, we're going to be increasing loans without, we need to be doing it in a manner that is not impacting the quality of loans. Now, it is safe to say that every financial institution, they're starting from zero each year. We need to issue more loans. But then each time you issue more loans, the pool of funds or the pool of persons to lend to in a small economy is getting smaller and smaller. So how do you end up lending to persons who you didn't lend to before in an economy that is tied to the fate of their economy is tied to an external force or external forces? Now we have to get creative around how we actually issue loans. So the challenge around issuing loans, it has to be looked at differently if we want to grow. Increasing the spread is outside of a lot of it is out of our control because the amount of credit in the system is indirectly tied to what happens outside of our region. Fees, you don't want to do that because of the nuisance services. And reducing operating costs while impacting service quality is something that it won't be an overnight phenomenon. It takes time because at the same time you want to have a nimble organization without cutting on quality. So just reminding you in terms of the entire discussion on governance, because what we're going to talk about now is the overall structure of investment governance, right? Investment management governance speaks to portfolio, the idea around, and everybody who has managed any financial institution knows these elements. But the governance structure must have in place a process around first setting what the investment objectives are. 9 out of 10 times the board approves these investment objectives. The risk level of the board or the organization has to be determined, and once that risk identification is done, some framework of an investment policy is created where the board approves that investment policy. And it is used to capture both the risk tolerance and all the nuances around the management of the portfolio. Now, this is not done in isolation because the returns, what's the loan rates like? What's the competition like in creating that overall investment portfolio has to be factored in. Once an investment policy is created and asset allocation, how many of each loans are we going to be issuing? What's the credit score associated with the loans that we're going to be issuing? And all of that ties into the potential return that we can see that can be made from these investments. The execution stage, that's where we're going out, and treasurers across the all financial institutions, they're working with sales team to execute on what type of loan gets added, how much of it do we, when loan demand is low, how do we increase the earning assets, how do we increase asset investments? And then there's our own monitoring and rebalancing aspect of it, in that that whole process has to go back to the board or the respective committees. So that entire process and the trunk of it is in the execution and in the monitoring phase, right? That process has to be nimble, right? So we started out and we talked about all the challenges that the industry face. So treasurers and investment managers across institutions facing all of these constraints have to continue to say, okay, we need to make money. But in order to make money, we have to operate within this governance framework. Now, good governance from time to time, therefore, is seen at odds with the profit motive, right? Where the investment manager, the portfolio managers, the treasury managers, they would like to be able to quickly move and execute on an opportunity that they see, or quickly change the strategy as the markets change. Now, interest rate policy is not waiting on the next quarter or board meeting to be held, right? It happens immediately. A shock to the global system can happen overnight. So the process around how do we maintain good governance, but at the same time have it be an enabler rather than a roadblock, is what everybody would love. Risk, anybody who has ever had to deal with risk, they're seeing risk as, again, being odds with profit maximization. Risk managers are looking at what can go wrong. The asset managers are looking as to, okay, issuing these loans, we believe they can earn us a good return for the organization, and what is that trade-off. So the whole procedures around how we make decisions within a particular governance structure can also be seen as bureaucratic and slow. And in 2021 and beyond environment, that can't be the order of the day. It has to be nimble enough to respond to changes as they occur. A good governance structure also may be seen as increasing operating costs. The subcommittees, reporting, the monitoring. Now, again, remember, we're in an environment that is extremely volatile. We're in an environment in which we have concentrated risk. We're in an environment where competition will come. It's not if, it will come. And as such, we need to ensure that we're protecting stakeholders' investments, but at the same time, we need to continue to make money. To do that, the cost structure associated with it may be high in setting up the respective committees and reporting and the monitoring and the tools involved in monitoring credit within this new environment. So in terms of the case for good governance, I think everybody knows that the research has shown that listed companies that have a strong governance procedures enjoy lower cost of capital and better company performance. So, and the thing around that is that people actually see performance as are seeing good governance tied significantly to performance and this overall lower cost of capital, right? So, if you think about it, whenever there's a financial scandal, there's always it always happens right around when there's volatility in the market, where basically what happens is, During the good times, things can happen under the radar. During bad times, when the tide goes out and people are left exposed, you're able to see some of the issues. So we can mention Bernie Madoff, the London whale. They've cost the system a significant amount of capital, 6.2 billion pounds from the London whale alone. One currency trader, $1.4 billion. Now, the risk and governance associated with how and what he has done or was doing is significant. So, in terms of, the case is good. Now, our take on it is that governance also instills discipline. So this same chart in terms of the overall U.S. treasuries. So at the start of the pandemic, right, where we saw interest rates go down, where we saw average spreads fall by 156 basis points, a sound, well-structured IPS that has allocation of X% to particular credits. During a time of volatility, you have a clear plan. The IPS already works, so what it instills certain amount of discipline. So during the times when interest rates were at all-time highs, bond prices or credit prices would have been significantly depressed. And as such, what you should have been doing at that time is actually increase exposure, right? Increase exposure. Interest rates fall, the IPS structure would have also then changed. And as such, you should have been decreasing exposure. So during last year, where we saw asset prices because of massive amount of stimulus in the system, on your balance sheet, you would have been seeing significant amount of gains on your investment portfolio. Your loan portfolio would have been hampered during that period because nobody's borrowing at that time. Credit policies would have said, okay, you should not be lending at that time because we don't know the future. But at the same time, what we're seeing, what the IPS would with a disciplined approach would have said, okay, now is the time that you should have been reducing your investment portfolio, locking in gains. Interest rates are now heading back south. You should be looking at now the allocation to different credits. And a disciplined investment strategy or governance framework on IPS would instill a result or a behavior that over time works out 9 out of 10 times. Right? It's the same thing. We can also see the same thing if for those who have portfolios invested in equities. During the pandemic, your asset allocation to equities would have gone down significantly, and as such, you should increase your exposure. So you started out at a 50-50 allocation to equities and fixed income. Asset prices have fall. Equity will now represent a smaller percentage of your portfolio. You should be allocating more to equities. Doing that, you would have then benefited from the upside. Again, at the peak, your asset allocation would say, okay, equities is now above your target allocation. You should be reducing your exposure. And we continue just like that. And so the idea of an IPS or a sound governance structure not giving you the flexibility to make money is a bit short-sighted, in that a disciplined approach, once it is created, makes sense. So there is a case for good governance. Good governance also forces us to be diversified. We've known for more than 50 years now that a well-diversified portfolio allows you to reduce overall risk without, even though you have individual risky assets in your portfolio. So the sum of all the risk in your portfolio is not, the sum of all of the risk in your portfolio is less than individual risk of each asset, right? So, and that is because of the correlation. Once we have diversification, once all the assets in my portfolio are not the same, once I'm not concentrated when one part of my portfolio is going down, the other part is going up. So overall, the risk level is lower. So we've known that for some time now. So a sound governance structure and investment governance structure enforces this constant discipline of diversification. Now, we operate, the markets in which we operate, as we pointed out at the top, is concentrated. So the real question is, how do we still maintain value to our members, our clients and our investors, but at the same time be diversified, be nimble, and be quick? So where is the win-win, right? So that we know that there is benefits to governance. I don't think anybody here would say, we should get rid of sound governance practices. But where we know that governance structures can be rigid, we know that governance structures can not be as nimble as we need them to be. But so how do we create that win-win scenario? We need to look at governance from a different line. Governance reimagined. How do we enhance the governance framework, factoring in the new landscape, the way we operate now? So where to do it, we have to enhance organizational capacity, right? We have to find a way to ensure that the stakeholders, the gatekeepers of this the governance framework, are equipped with the knowledge and the skill set and the technology to allow them to make decisions, because we need a new way of making a much more nimble system. And as such, everybody in the process needs to be able to appreciate the assets and the changes that are necessary. So in order to create this nimble, effective governance framework, or to relook at the governance structure, we need to ensure that we have the supporting teams. Now, we are now in a world in which, in order to make money, we need to be able to invest in other assets, other type of assets. Now, all of that comes at a cost. To build out an entire new risk framework or research framework will cost us money. So how do we do it and still maintain operational efficiency? So governance, again, reimagine. We need to enhance in terms of enhancing the organizational capacities. So as it gets more complex, we need to ensure that all of the stakeholders and the gatekeepers, internal and externals, understand different asset classes. You can't be a head of an investment committee and be intimidated by the investment manager or the credit manager or the treasury manager showing you assets that look different, because it will require different assets in order to continue to remain competitive and meet the necessary hurdle rates within our organization. So because we're thinking about loans that look different than how they were done before, because competition will force us to be that. So we have to enhance the organizational capacity. To create that sound framework, we need to create an effective governance framework that is nimble, making decisions quickly, factoring in the changing landscape, and it's not done, it takes forever. It needs to operate quickly because markets and this new fast-paced economy now changes significantly. How do we incorporate a credit policy that allows us to borrow and lend across jurisdiction? There's this home bias where I understand lending to nationals in my borders, the asset quality, we know the collateral, we know everything. We need to be thinking as a region and as a group, how do we allow more flexibility to be able to do that? What's the technology? Our stakeholders need to understand that it doesn't mean that we're taking excess risk. It's done within a framework that they understand. So in terms of reimagining the governance framework, we also need to look at the supporting teams that we mentioned, the research capability, the risk capability, the risk capability to support this new fast-paced changing structure. The traditional loans will still represent a big part of our business, but then as spread continue to contract, and because we're in this low interest rate environment, we need to be able to say, okay, how else can we make money by issuing non-traditional type assets? And non-traditional doesn't mean we're taking excessive risk. We're designing new products quickly in order to meet this changing demand. So do we build or do we buy this resource? How do we create this structure? Because at the same time, we need to enable operation efficiency. Entity one, a small bank in Jamaica may decide that, okay, we want to build out and get this capability and be nimble and be quick and reimagine our structure. And as such, you're going to hire an entire research and risk framework. And the same thing happens to entity two in Trinidad. But when you look at the operation, what that will do is increase the operating costs per entity. So we need to be looking at how can we benefit from economies of scale in order to make it work. The operational efficiency, outsource where you can, because your costs, your revenue side will be constrained, and as such, spreads are going to be thinner. So how do you continue to build in the necessary framework and support needed, but at the same time be nimble? So it needs to be nimble, and to hire these resources will cost money. So we have to see how we can outsource, let people who specialize in one area specialize in that area, and at the same time benefit from overall economies of scale. Because remember, we're a small region with not a little shy of 5 million people in the English-speaking Caribbean. So in summary, as recognizing the time, in summary, we recognize that we need a new way of thinking about governance. We know governance is important. We know that it's critical to respond to the changing economic climate. As interest rates volatility will not go away. It is going to be there. The check Bloomberg today is a different story than when it was yesterday. In terms of how it impacts our nation, our small island state, we know it will happen. It's not if, it will impact how we do what we do in the Caribbean. And as such, we need to be nimble. We need to, we love the governance system. We know it works. It pays off. The research says that good governance works. But slow governance, however, can be a detriment to an organization. So you need to be able to move quickly. It will cost to move quickly, but the win-win is to be able to find a way to benefit from building out that entire infrastructure and at the same time maintain operational efficiency. So how can JMB help? As I pointed out at the launch, I spoke about that. I'll identify the problem and make the case that it is critical. We've seen that a solid IPS, which is at the heart of any solid governance structure, would have been able to allow you to make money during a pandemic. So we know that it works. So the solution is, okay, a sound governance structure with the right support team is necessary and can be profitable, but it costs money to do that and to roll it out in any major way. So we're saying, how can we help? In terms of the issue of how do we help to increase organizational capacity? So JMB has rolled out a service called Investment Management Services, and the idea behind that is a part of that model is that we support clients in building in-house capacity for stakeholders. So we have a corporate investment management services that we then leverage on all the knowledge that we've gained over the last 20 odd years to say, how can we utilize all of the lessons learned going through pandemic, going through recessions, going through different climates, economic climate? How can we use that to help corporate clients? To support this entire structure, we have a built-in structure to support organizational capacity. So we basically partner with entities to support both the theoretical and the practical training. So, in terms of at the board level, at the investment committee levels, what do you look at? How do you measure performance? What do you do in terms of creating an entire nimble process? We built out that entire structure. providing outsourcing opportunity. All right. The cost of putting in a risk management structure that makes sense, or research management structure and research and risk management structure, it costs money. Leverage on our expertise to allow us to better allocate. So rather, you don't have to build it yourself. We can support that whole build out. So the service incorporates various modules. You could just look at just the investment management support element of it, which we look at their IPS, we drive allocations across fixed income, equities, and other assets. So there can be the loan portfolio and an investment portfolio is outsourced, where different sources, whether or not it's cash management, regional reach, how you diversify your portfolio. This investment model can support that. It's very nimble and very able to respond to different type of structures. The risk management framework review the entire risk management framework of the client, and reviews the policies, the procedures. We look at how you monitor risk now, leveraging on the resources and the technology, value at risk, concentration reporting, exposure limits, all of that in a nice package at fractions of what it would cost to build out if each entity tried to build out on their own. The research capability, again, you could just package that research capability to say, all right, I want that structure. I want to be able to understand the global, the country, and the sector and specific assets. Leverage on things that exist already rather than redoing it yourself. Now, it's safe to say that international brokerage house may not pay as much attention to the regional entities, again, because we are small island states. But JMB with tentacles within the group, or across the Caribbean region, we recognize that we have to be looking at these markets, and as such, we are more in tune with what happens in the Caribbean than any brokerage house outside of the Caribbean. So our core, at the core of our value proposition is that we're here to customize any form of solution to meet the varying needs of the different clients that we have within the group. We're reaching out to institutional clients because we believe there's a way in how we can help support them to get more robust investment management framework and risk monitoring, and we're leveraging on the fact that, okay, we're a small islands, we're a small group of islands in terms of population. However, and as such, we need to be looking at how can we consolidate where necessary, how can we use economies of scale to actually meet the profit motives as spreads continue to contract and markets become more volatile. So I know I went through it quite quickly, but that's the end of my presentation. So, we can look at any questions or comments. I know I went through it probably quickly. Put it this way, we're open. We're looking forward to any form of questions that you may not be able to post now, but Alwyn and his team, my team, we're ready to support whenever ready. All right, so in terms of looking at in terms of the support, so yes, we can share the presentation. I'm sure.
Yes, yes, Peter. We also have a booth that we're currently manning. So if persons want to come over and meet us and kind of have an interaction, we can definitely, we're welcoming everybody to join us at the booth as well for further one-on-one discussions. However, there's actually a question, Peter, in the Q&A. It's from Harold Lewis, a very good question, and it reads, how can credit unions make sound investment decisions to diversify their portfolio given rigid regulatory guidelines that are not abreast with the dynamic investment climate? What do you say about that?
All right, excellent point. And a part of it, and we talked about the institutional capacity of the stakeholders. So, and probably not right. Regulators are in the business of trying to ensure that you don't destroy shareholder value or destroy depositors' money. But they're also open to, they also have a dual role in terms of they want to see every institution be profitable, right? So it will require some amount of dialogue in other industries, in the banking industry, in investment industry, there's lobby groups that say, okay, we want it to look like this. Here's the points pro and against, and that's how you change regulations. While we wait on that, the decision-making process needs to be more rigid, because we need to be able to show regulators that the investment framework and credit unions not seen as this entity outside of your big brother who is the banking sector that is more in rigid and more structured. Credit unions need to be lobbying to say, okay, we have built out our processes and procedures of monitoring risk and investments, and we have the capability to do it. And as such, lobby for changes to be made to the regulatory framework. But while we wait on that, there are ways regulators how to meet regulators' objective and our objective. One may be, okay, you can only invest in a particular region, or you can only invest in the credit quality of certain assets need to be high. Or there are things that meet all of those criteria, as in it doesn't run afoul of any regulatory guideline, but is able to provide the type of return that allows us to be diversified and at the same time give us some amount of return. Now, and again, if we think of it, Mr. Lewis, in just isolation, where we're in our little corner, in our jurisdiction, in our country, and we're just looking at what we are seeing. When there's an entire Caribbean and there's people who have thought about different elements of this and may be able to support. So I would say, as a union, the lobbying needs to happen simultaneously to say, okay, change it. But also the policies, the procedures, we need to show everybody that we have the framework to monitor risk and to make some decisions. And I think it will go easier with the regulators when it comes time to change.
Thanks for that, Peter. I also see a follow-up. I am Karen Hewitt Kennedy's asking, and I think she's adding to Arrow's question in terms of, she's asking if will the BOJ, the Bank of Jamaica regulations, allow for any changes. I'm not sure if you could speak to that, Peter.
So in terms of the regulations, the BOJ regulations for in Jamaica, so I'm not there in terms of that moving elements and that what finally comes out of that. I think a benchmark would be to say, all right, based on how banks operate, I think what the BOJ regulation was try to seek is try to say, okay, we want them on some similar footing. And so, but what I can say is that there's no doubt that the amount of reporting that the Bank of Jamaica will require, because we do know what the reporting structure is like for banks, and it will be heavy.
Yes.
Now, that regulatory cost that will be placed, how are we going to pay for it in an environment in which spreads are where loan rate and investment rates, or loan rate and deposit rates is not as big as they were in the past, and there will be that pressure to keep it low. So yes, it will happen, and as such, we as a grouping should be more prepared for those changes.
Okay.
In terms of the final thing, we're not 100% sure.
Right. I just want to acknowledge that we have quite a few persons online. We just want to thank them for joining us for this presentation. Peter, there's another question from Ivor Blake.
Right.
And the question reads, what are the best way all credit unions to leverage these solutions offered to formulate, customize their governance structure, policies to maximize their business model in this dynamic environment?
All right, excellent question, Mr. Blake. All right, so we at JMB and through Alwyn and his team, he has been doing an excellent job in terms of PACE kind of getting a feel for what it is, what are the needs of the small credit unions. Every conversation we have, we get more, we tweak our solution. So it's safe to say that we don't have a one-size-fits-all type of solution. We look right in the eye of the client and we work out what is the solution that best works for you. So the first step is, let's have a conversation. Alwyn and his team ready. Let's have a conversation to say, all right, how can we create something that works for you? We have done it. As in, we do have credit unions under our, in terms of relationships with them, and we do some work with them also. So the issue is, what is the solution that works best for credit union number one? Number two is different. So let's have the conversation and let's create something. We have a boilerplate one that touch on capacity building, skill set building. Some of it is not ourselves doing it. We partner with another entity to give the theoretical framework. But then the hands-on, what are the tools we use, how we make decision, reviewing your current framework. That is something that our risk and our research and investment, we come together and we provide a solution that works best for each entity. But it starts with having that conversation with Alwyn and his team.
Okay, great. Thanks, Peter. Cognizant of the time, I think we're 8 minutes over our allotted 1 hour. Just to repeat as well that we do have a booth that we're available to speak to persons on a one-on-one basis. In addition to that, as Peter alluded earlier, my team, even though we're based in Jamaica, we do have operations in Trinidad, and we partner with those relationship managers there as well to offer the best solutions to our business, corporate, and institutional clients. So we're available at any time to have a further one-on-one meetings and discussion with all, the credit unions, because the credit union we've been partnering with them from ever since we've been in existence and offering them various solutions. We know from a regulatory standpoint that there are certain things that they're not able to do. And that is why I view the questions from Harold and Iba to be very important and excellent. But at JMB, we always have a solution for everyone. And so we're willing to have further dialogue and discussion with our partners within the credit union, the Caribbean Credit Union Confederation. So I'm not seeing any other questions, Peter, but I'm going to just invite persons to come over to the booth and have discussions with us. And just want to say, Peter, again, thanks for the excellent presentation. I think it was very useful. Based on some of the comments I'm also seeing in the chat, persons, thought it was a very, very, very well presentation done, and the information provided was useful. So thanks again, Peter. Right. Thanks to everyone for joining us. We're here and ready to support and partner with all our credit unions, not only in Jamaica, but right across the region, and look forward to having further discussions and one-on-one meetings to see how best from a JMB standpoint we can provide various solutions to help your business maximize and grow as fast as you can in such a changing environment. So thanks everyone, and thanks for joining.
All right, and thanks everybody, and everybody remember to keep safe.
Great, thank you.